Have you ever wondered about the future of the market? What could be the potential risks that lie ahead? Today, we delve into a fascinating perspective from David Stockman, who anticipates a significant market repricing that could kick off as early as 2025. This change could lead to downward adjustments of 30 to 50% across various asset classes. So what's driving this prediction? The driving force, according to Stockman, is the imminent end of the Federal Reserve's ability to monetize massive government debt due to persistent inflation. In his view, we're currently at the tail end of a 30-plus year period where artificial Fed policies have created unsustainable asset prices. There are several key contributing factors to this looming situation. For instance, we're grappling with structural federal deficits of 6 to 7% of GDP, coupled with a current debt of $35 trillion. Both major presidential candidates are proposing significant additional spending and tax cuts. Furthermore, total public and private debt stands at a staggering $100 trillion, which is 350% of GDP versus the historical 150%. The bond market is already showing signs of resistance to Fed rate cuts, with corporate and government debt rolling over to much higher rates. So, what does this mean for your investments? To weather the storm, you may want to consider investing in short-term government securities in the 1 to 5 year range, yielding 4 to 5%. Treasury inflation-protected securities, also known as TIPS, could also be a safe bet, as well as gold, which can serve as long-term insurance despite its short-term volatility. On the flip side, you may want to steer clear of long-term bonds, equities, especially tech ones, and real estate. The anticipated repricing is likely to begin in early 2025 and could last many years. Stockman references the peak in 1929, which was not recovered until the 1950s. Unlike previous crises, the Fed may be unable to rescue the markets due to inflation constraints. In conclusion, this potentially turbulent market scenario suggests that investors should consider reducing risk exposure and positioning more defensively heading into 2025, with a focus on capital preservation over growth. Remember, in the world of investing, knowledge and preparation can be your strongest allies. Stay informed, stay prepared, and navigate the future with confidence.